Good morning, everybody. Welcome to today's webinar. My name is Stephen Kimenye, and I'm the Head of Programs here at Global Compact Network Kenya, and we're very excited in partnership with ISPAC to bring you this introductory webinar to IFRS 1 and S2, what you need to know about the regulations. Thank you very much for keeping time. Apologies for the delayed start. We're just fixing some technical issues, but we are more or less ready to go right now. So I'll start off with a brief introduction for those who are not familiar with the Global Compact Network Kenya before we go into the main content of the presentation. I'll ask you all to just put your microphones on mute.
Like I've logged into my computer.
Great, so we'll just proceed with the presentation now. So for those not familiar with the Global Compact was started in the mid-2000s, and this was an initiative of the late Kofi Annan, who was the UN Secretary General at the time. And it came at a time when it was becoming a reality that business, the private sector, has a key role in driving sustainability. So prior to that, it used to be a very public sector driven conversation, but it was necessary to bring the private sector to the table and to unite the private sector, the business leaders, to come together around a set of shared values and principles, which we call the 10 principles of the UN Global Compact, that support organizations to embed processes and policies within the organizations that allow them to conduct their operations more sustainably with a positive impact on people, profits, and planet. Our work, as mentioned, it's a structured framework, and it's grounded under four thematic areas: human rights, labor, the environment, and anti-corruption. And all of these map onto the 17 SDGs as we know them. So you see how human rights becomes a poverty issue. Environment creates poverty. You have environment, so the adverse effects on the environment lead to poverty. Corruption and fraud and governance decisions can also lead to poverty. And that's why we have these 4 different lenses that we apply across the 17 different SDGs that guide how we support the private sector in becoming more sustainable. Globally, we have a global footprint. There are over 225,000 businesses world over that are committed to the 10 principles of the UN Global Compact. More than half of these are SMEs, and the same ratio applies here in Kenya, where we support over 300 businesses as participants of the Global Compact Network. There are 170 different countries that participate, and over 70 networks, much like this one here in Kenya. And all of us follow the same principle of programming, which is our 10 principles across these 4 thematic areas. How we support the businesses is really guided by our strategy, which is to equip companies to connect, to drive collective action, and to develop the business case for sustainability. We do this in 4 key ways, which is we call them the connect, learn, lead, and communicate. We create platforms for connections, much like this one, but also in-person platforms where we can convene around workshops, conferences to share sustainability challenges and solutions and learn from each other, which takes me to my next avenue of support that we offer, which is through learning. So we have learning that takes place in different forums, much like today's webinar. We also have learning that happens in workshops. We organize workshops, accelerator programs, peer learning groups, and more importantly, we also have our academy. Our academy for UN Global Compact participants is an online repository of courses that are available on demand to all employees of any organization that is a participant, a member of the UN Global Compact. Alongside this, we also supply or support with a lot of tools and resources, thought leadership, documents, publications that help shed light on either of the thematic areas aligned with the interests, the learning interests of different organizations and individuals that engage with the academy. Another avenue of engagement is through leading. We create platforms where organizations that are exemplary in sustainability can share best practice with other organizations. So this happens, of course, through our events and also through webinars. We organize events where participating organizations can share their leadership on a national level, on a regional level, but also on a global stage. The last area of support we offer is through communication of progress. Sustainability is a journey. You start from point A and you walk that journey of sustainability maturity. So we support businesses in communicating how they are making progress through a structured framework, which we call the communication of projects. So year on year, we are able to support organizations to map their progress and their weak areas. So we started in year A. This was our baseline. This is where we stood at. And now in year B or C, this is where we have progressed. This is where we are stagnating. And this is where we need support. So we support in how we communicate this progress to the relevant stakeholders that you would have, be it the regulators, be it your customer base, be it your investors. All of them needs to see where you are today from a sustainability perspective, and that's how we support you through those 4 different pillars. So I didn't want to spend too much time on our introduction because we have quite a long session ahead of us. That's a deep dive into these 2, into the IFRS S1 and S2. So we'll leave this link here and also share this presentation at the end with more information on how you can be a participant of the Global Compact and the value that you would get from participation. At this point, I would like to welcome ISPAC through CBA Elvis, who will take us through the remainder and the deep dive of the presentation. Welcome, Elvis.
Okay, Steve, please confirm you can hear me and that you can see my screen.
Your audio is good. We're waiting on your presentation.
Okay. Just wait a bit for that. Let me know once it comes up.
Sure, I'm still waiting.
For some weird reason, I could also not see your presentation when you were walking through the initial slides.
Still not loaded.
Should I try jumping off and then jumping back in to see whether it will pick up?
I'll just present them from here and you can just guide me on next slides.
Okay, the problem is that I won't be able to see your slides, but try from your side. Yeah, I think you just allow me to jump out and back in again.
Sure, no worries. To the participants in the room, kindly requesting confirmation that you can see the presentation, and if the audio is clear, thumbs up would be great. Thank you, thank you, thank you. Kindly bear with us as we confirm this.
Yes, we can see it.
Great. While we wait for Elvis, perhaps I can take this opportunity to also introduce the colleagues that we have here with us from Global Compact Network Kenya, supported here by Ivonia, who leads our participant engagement team, and Damaris. Please feel free to unmute and introduce yourselves. Thank you.
Good morning, all. Thank you so much for joining us. We are glad to have you on call. My name is Ivonia Arena. I'm in the participant engagement team. We look forward to a really engaging session. You might be muted, with that can be changed much later, but put your feedbacks on the Q&A section and the chat section, and we look forward to supporting you throughout this regulatory reporting period.
Thank you, Ivonia. Damaris, please feel free to introduce yourself.
Good morning, everyone. My name is Damaris Mukulu. I'm the Communications and Marketing Manager at Global Compact Network Kenya. A question that I know is going to come up a bit later on is whether the presentation and the recording of this session will be shared, and the answer is yes. So by tomorrow, you should be able to have a copy of both in your inbox. Thanks again for joining us, and I see Elvis is back on the call.
Thank you,
Mary is
Ivonia.
also
Thank you,
here with
Damaris.
us. Mary is also here with us.
Oh, sure, please, go ahead.
All right, good morning, everyone. My name is Mary Wawero. I'm also part of the participant engagement team. Lovely to engage with all of you. We're looking forward to a very interactive session. Over to you, team. Thanks.
Thank you, team. Elvis, the floor is yours.
Thanks, Steve. Do you want me to try sharing mine? I can see yours. You want me to try sharing from my end?
Perhaps it will give you flexibility.
Okay.
Great. We're in business. If you go full screen, and we should be good.
Okay. Good now?
Great. Go ahead.
Fantastic. So thank you so much to the Global Compact team, Steve, and the entire team that has made this webinar possible. My name is CPM Moenga Elvis from EastPac. I manage professional standards and sustainability. And it's an honor to be here to share some of the insights that will come with this new reporting landscape that will become mandatory, as you'll see. So I'll dive straight in. And the first thing perhaps we can consider, imagine it's 2030 and your largest customer requires sustainability disclosures. Furthermore, your lender, for those who are borrowing, is requesting for climate risk information. What about your investors? They're asking whether you have transition plans. And to add to that, a major climate event disrupts your operations. Now, these questions, these kinds of questions do not sit the question for us is, are organizations prepared for this new landscape of reporting? And that's what we'll cover in the next slides. I have about 45 slides and I'll walk us through this. Feel free to drop your questions in the Q&A and we'll be able to tackle them at some point. Now, it'll be important to start from what sustainability is. And the earliest definition of what sustainability is was, or rather sustainable development, was through what is known as the Brundtland Report of 1987. And here they define sustainability as development that meets the needs of the present without compromising the ability of future generations to meet their own needs. And over the years, this has been christened through the acronym ESG, which is environmental, social, and governance. And this is what most of the people in this call I know are familiar with. But one thing to note is that sustainability is not an environmental program, but rather a long-term management of the value creation process. Environment has for a long time, been the poster child of anyone who's discussing sustainability. Maybe because for a long time we have been feeling the effects of climate change as a globe. And so environment has been the pillar that has been mostly at the forefront. at the expense of social and governance. Now, it's also important to know where we came from in terms of the evolution of corporate reporting. One of the events that marked a change in the global reporting landscape was the 1929 Great Depression. And here, there was a market collapse because players had different ways of presenting information, particularly financial information. And there was a lack of transparency in this space of global reporting. Then this necessitated the development of what we now call financial reporting standards. And here is where things like accrual reporting for those who are in accounting was birthed. And this information further brought transparency, comparability, and of course, investor confidence was improved. And then the other evolution was around globalization. Now that financial reporting standards were working, especially in the West, there was a need to have comparable information across the board. And here is where international financial reporting standards started being developed, so that a capital markets in Nairobi or in Joburg or in any other place in the world can have comparable information across similar companies. The other evolution has been around intangible assets. Many and more investors are now relying on knowledge, relationships, and brand as key drivers of value and decision making, as opposed to historical information that sits in current financial statements. And then in the recent past, we've had climate, we've had nature and social risks coming to the fore. And these issues have now been accepted to affect enterprise value and long-term viability. And this is where now sustainability reporting was born. So they emerged to provide decision useful information on risks and opportunities, which have not in the recent past been captured in your traditional financial statement. So sustainability reporting sits at the same place where financial reporting stood after the 1929 market collapse. And the whole reasoning is that investors are demanding for better decision making and long-term value creation. And this is through information that comes out of this reporting. Now, the other thing that I felt would be important to highlight is that in the past, value was primarily driven by financial capital, but now our capitals have since expanded. Over and above financial capital, now we have natural capital, we have human capital, and we have social capital. And then financial statements, as they were, could only communicate historical performance. Now they are communicating this through this kind of reporting. We are now evolving to communicating about future resilience and how we are managing risks, especially climate risks and other ESG risks that have emerged. Yesterday or in the past, profitability was the primary focus. Now we're asking organizations to tell us, how are you creating value in the long term for not just for your business, but all stakeholders? So this shift is very important because now organizations are being asked to report on more than just profitability and headline numbers. So if you're seated here and regardless of your organization, sustainability matters to every organization, and you could argue this is perhaps what you'd call the business case for sustainability. So the first thing is around revenue. Through sustainable practices, entities are able to strengthen their revenue sources and innovate within a market that is increasingly becoming competitive. Sustainability has also enabled organizations to cut down on wastage to operating costs by coming up with efficient ways of operating that, of course, cuts down on the operating expenses. In terms of risk, sustainability reporting has enabled businesses now to fully appreciate the extent to which risks that would not traditionally sit within your general purpose financial reporting affect enterprise value. And then increasingly, we are seeing investors asking for sustainability information, and this could be tied down to access to capital. They're now asking you, what are you doing about your people? What are you doing about the environment? How are you conducting business? And in the near future, we'll see most of this information feeding into even interest rates, even within our market, such that sustainable organizations would ideally have access to cheaper capital. In terms of talent, everyone wants to work for an organization that is not just about churning out numbers, but has a purpose beyond just profitability. Our customers are also evolving. They are asking for, uh, you know, sustainable products, and in many industries, including hospitality, including even products themselves. Now the customer has become more aware about the impacts of business on environment and society. And then finally, the license to operate. In some industries, trust and credibility are very important. In fact, yesterday I just saw in the news an entity called Tata has been banned from mining in Kenya, purely because they are not taking into cognizance the fact that they need to have stakeholder buy-in even as they extract minerals from the communities in which they serve. So sustainability is not just compliance issue, but is a pathway to long-term value for many organizations. Now, why should investors or why do investors care, and what do they want to know about our sustainability reports? First of all, I have to say that IFRS S1 and S2 standards are built with an investor lens. So this means impact of business on the world or in the environments in which they operate is not a primary focus of IFRS S1 and S2. That is where other standards which are interoperable, such as GRI, would come into play. But from an investor lens purely, investors are asking, is your business resilient? Can we navigate the changes that come as a result of sustainability-related risks and opportunities? And how are these risks being managed? And of course, in terms of opportunities, are we positioning ourselves to take advantage of opportunities as a result of these changes in the landscape? So this is why this information is important, and hence why we are here today. Now, in terms of our agenda, I'll take us through 10 subtopics. I'll start with covering what these standards are. I'll speak to what board and management need to think about. Speak about financial materiality. I'll do a small deep dive into S1 and S2. Then I'll highlight the data and reporting challenges, the financed emissions, risk management, assurance readiness, and implementation roadmap. I saw a hand going up. Allow me to, if you can drop your question in the Q&A, allow me to just walk you through some of the content, and then I'll pause at some point for questions, perhaps in the middle as well. So just note it down, and then I'll be able to take the question. Now, jumping straight into the content, for all of us who are on the call and are representing various organizations in our various leadership capacities, the first thing you need to understand now, before any reporting, is what risks could affect the nature or the type of business in which we are in. What are the short, medium, and long-term horizons of these risks? And generally, what are the climate and sustainability-related risks that could affect your business? After that, you need to govern. You need to look at what are some of the governance structures that we need to put in place. We have board oversight. What controls do we have? Are we assurance ready? And this is the period in which we are in, all the way through to Q4 of 2026. Then for all of us who happen to be public interest entities, we've released a number of circulars into the market on who a public interest entity is. And the public interest entity is anyone who is a bank. I think I have a slide on that. I'll show you that. But public interest entities are required to report, to do a mandatory sustainability report from 1st January 2027. And then, of course, assurance will follow from 2028, limited maturing into reasonable assurance. And the way to really think about what a sustainability related event can do for your enterprise value is to think about it in terms of the operational disruption that could be caused, what that disruption means from a financial impact perspective. Does it mean that you will have reduced revenues? Does it mean that increased expenses as a result of some of these disruptions? And all these things will have consequences from a strategic perspective. And of course, your stakeholders will also respond in light of the same. In terms of these standards, we have seen this shift from a voluntary to a mandatory sort of landscape when it has come to sustainability reporting. And I could trace it back to the Paris Agreement, where 195 countries, including Kenya, have signed up to on climate action. And Kenya has signed up to, I believe our national determined contributions now are to reduce emissions by 5% by 2030. I believe that's still our target. But this was perhaps one of the seasons in which climate reporting began to take cognizance. Then TCFD, which is the Task Force on Climate-Related Financial Disclosures, became one of the frameworks that was developed to be able to report on climate in 2021. And then piggybacking on this, the ISSB and the ISSB is the International Sustainability Standards Board, who were tasked to come up with a global baseline for sustainability disclosures in 2023. And in 2024, we saw jurisdictions in the West, primarily in the EU market, put in place requirements through the CSRD, which is a corporate sustainability reporting disclosures, for entities to start reporting. And these regulations were built around S1 and S2. And then in Kenya locally, we did announce ISPAC as the standard setter and regulator. We expressed our interest to adopt these standards in 2023. And in 2024, we developed a roadmap for adoption of these standards. This roadmap is accessible on our website. And 2025, this is when we were requiring entities to start putting in place their readiness assessments to be able to comply with the standards. And now from 2026 into 2027, public interest entities will start preparing the first reports. Now, what are these standards and what are they not? So they are not ESG marketing, they are not voluntary, they're not a replacement of GRI. And more importantly, they're not just the sustainability team's job. What they are is investor grade disclosures of risks that affect enterprise value. They are now becoming mandatory, and they're based on financial materiality, how the world impacts our organizations. And more importantly, in terms of ownership, they're owned by the board and CEOs of the company, same way that we own financial statements. I already spoke to this, but in terms of how our adoption journey has come as a country, we are now at this 2027, January 27 window. That's what we're looking at. And all public interest entities, including SACCOs, including banks, including insurance companies, anyone listed on the NSE, regulated by CMA, and any state corporations reporting on IFRS will be required to produce a mandatory report. This will be followed by large non-public interest entities. And here I'm talking about large corporates as defined by the MSME policy of 2025 in Kenya. And in 2029, all other entities, including SMEs, will follow. Now, it's important to note that for public interest entities, you have 1 day or is it 2 days between today and tomorrow, to do a mandatory readiness assessment, which is a web-based tool that is on the ISPAC website. And after 31st midnight, the platform will be closed. So in case you're here and you're a public interest entity and you have not already complied, please go there and do this mandatory assessment. That assessment will form not only an internal locus on how an organization should look at the gaps that they have, but also will form the assurance material that an auditor will come and that's the first thing they come to audit your disclosures. In terms of the regulatory landscape, I know I've mentioned this, those are the public interest entities that are in scope for 2027. And what this means is that, of course, disclosures will be mandatory. From 2028, assurance will also start being mandatory, starting with limited assurance. Directors will now be personally accountable for any material misstatements in those reports. And we are, in Kenya, what we are doing from a regulatory perspective is we are having all hands on deck kind of compliance journey where all regulators, including IRA, RBA, SASTRA, CBK, and of course the National Treasury, sit in a committee where we have come together to ensure that all our different articles are in compliance with these standards. And I forgot to mention that that committee is the committee that actually developed the national roadmap, in which we are now, of course, executing. Let me move to board and management accountability. So who, and forgive my title there, who owns sustainability disclosures in the organization? So the first people who are at the front line is your board, because your board provides oversight and governance. They approve your policies and they ensure that all risks that are material are identified and disclosed. Then CEOs, of course, sign off on those disclosures as part of their annual filings, and their release to set the tone from the top to ensure that there is controls in place to ensure that there is delegation where delegation needs to happen. Your CFO or your finance directors would typically ensure that the financial materiality assessments are rigorous and documented. Your ops teams and your HR sit on very important data that we need for reporting. And so that data needs to be collected, needs to be accurate, and needs to be submitted to your sustainability team. For organizations that have chief risk officers or a team that handles their risk management side, their role really is to ensure that physical and transition risks sit in your risk registered, over and above, of course, all other sustainability related risks that you will identify. And then your sustainability team would ideally be the ones who would coordinate everyone else and would facilitate, not own the process, so that ownership stays with the backstops with your board of directors. So as you notice, sustainability is a cross-functional kind of reporting requirement, and you cannot just have a finance team or a sustainability team preparing a report alone in a silo. Now, in terms of what we have been doing, so in the past, disclosures have been voluntary and very narrative. Now they are mandatory and structured. Primarily, they've been sitting with your PR and sustainability teams. Now we are saying your boards and your CEOs will be at the front line in terms of ownership. In the past, we have not been doing any form of assurance. Very few entities have been doing some form of assurance on their sustainability disclosures. And now we are saying external assurance will be mandatory. These reports in the past have been separate from your financial statements, but now, as you will see, they are required to speak the same language and they're connected to your financial statements. Finally, nice to have, now it's material to your enterprise value. Let me talk about financial materiality. Now, materiality is defined in IFRS S1 as risks and opportunities are determined to be material if omitting, obscuring, or misstating that information would influence the decisions of users of those particular statements. And of course, what it means is that if it does not affect either your cash flows, your access to finance, or your cost of capital over the short, medium, and long term, then what you determine to be a financially material risk to be reportable in your report does not need to be reported on. And so I gave a few examples of what financial materiality is not. So the first thing is your organization cares about the environment. That's a nice thing. But based on these standards, that is not financial materiality. Things like tree planting campaigns are not financially material to be reported based on these standards. Anything on impact, how you impact society, is not a requirement of the standard. Don't get me wrong, those things are important, but purely based on these standards, they are not considered to be financially material. Things like your CSR spend, your donations, not financially material. What is material is you need to tell us in your reports that water scarcity will affect production if you're in agriculture, for instance. And this will have an impact on your revenue numbers. You need to tell us if carbon legislation was to come in and a carbon tax was introduced in Kenya, then operating costs would increase. You need to tell us how you're transitioning from renewable energy to reduce your operational costs. You need to tell us how you're dependent on other sectors and how these high climate exposures could affect your bottom line. This is what we're calling financial materiality. This is not to be confused with impact materiality, which is what GRI is developed specifically for. Now, most organizations perhaps will want to report both ways, and there's no sin in that. The only caveat that the standards say you should need to look out for is that as long as that other impact information does not obscure the information required by this standard, then it should be fine. And that approach is called double materiality. And most organizations in Kenya will approach it from a double materiality perspective. Now, what does materiality in action really look like? And I did a few examples here. If you're in agriculture and there's a drought like we are experiencing now, if you go to Uasin Gishu and the maize planting areas of Kenya now, you will realize that we are set for tough times because the rains didn't come as anticipated. And so productivity has dropped. And what that means for an organization in the agricultural sector is that they will have lower revenues. And of course, any contracts that they had, especially for those who are in the export market, would be hampered. The other thing is, if you're in manufacturing, any rise in electricity and fuel costs can erode your margins and increase your costs. If you're in the financial services sector, things like financed emissions, where you're exposed to carbon intensive borrowers and investments, would mean that your collateral, your credit risk is increasing, and this could impair your asset values in the long term. If you're in the FMCG space, consumers now are becoming more aware, climate conscious. What does this mean in terms of your products and how you are placing them in the market? Are they taking sustainability seriously or into account? If you're in banking or in the financial services sector, continual digitalization and integration with platforms such as M-Pesa means that you're now exposed more to cybersecurity and technology risks. All these are sustainability related risks that could hamper your financial statements and your enterprise value. If in the public sector, what does it mean in terms of infrastructure resilience? In Nairobi now, we know that when it rains properly, there's floods. What does it mean for our roads, our water systems, our infrastructure? All these are things that could disrupt essential services. So these risks, what I'm trying to say is financial materiality is biased in the sense that it looks at what impact would sustainability related events or risks have on my enterprise value. And by enterprise value, I mean, how does it affect my statement of profit and loss? How does it affect my balance sheet? How does it affect my cash flow? I had a couple of questions here that we could have reacted to, but maybe these are some of the things you need to think about. Where is your organization most exposed? What risks have the greatest potential to affect our strategy, our operations, and our financial performance? Where does the risk currently sit? Is it a reportable item? Has it been quantified? And who is accountable for tracking and disclosing the risks? So these are some of the questions you could think about even as you start your reporting journey. Let me get into the standards. Let me speak first to S1. S1 is think about it as the backbone of the standards. And think about S2 and all the standards that will come later, S3, S4, as the themes. Now, S1 gives you the foundation, the principles for reporting. And S1 is structured around the 4 core content pillars. These are governance, strategy, risk management, metrics, and targets. Now, governance asks you a simple question. Governance asks, now that sustainability risks and opportunities exist, what structures do we have to oversight them? Is there a board committee in place? What roles has the board delegated to management? How do they inform remuneration of our boards and even the general C-suite and senior management team? Is our board competent on matters sustainability? Are they trained? That's what governance essentially is asking you. Does the highest governance body understand these risks and opportunities? And how does it inform strategy, risk, and metrics and targets? From a strategy perspective, once you have identified your risks and opportunities, the question then is, how does that affect our business model, how we do business, and our value chains? Because as you will realize, sustainability is broader than just your organization. It has to do with both your upstream and your downstream operations as well. And then most importantly, how does it affect enterprise value, our financial position, our performance, and our cash flows? And then in the strategy bit is also where climate resilience and scenario analysis would ideally sit, because then they would inform how governance approaches strategy, business in general. Risk is perhaps the easiest because most organizations have an enterprise risk management system in place already. We have been tracking risks in the past, things like liquidity risk, credit risk, market risk. These are risks that we are familiar with. Now we are adding a new dimension, and that is sustainability related risks. And then the question around risk management would be, how do we identify, assess, and deal with these risks once they arise? And of course, how has this changed our risk profile? And what is our risk appetite when it comes to this new dimension of risk? From a metrics and targets perspective, this is how we now measure whether we are making progress as an organization. For instance, if our target as an organization is to reduce our emissions by so much, how do we track that year on year? How do we report it in our sustainability reports? And more importantly, how do we go about that target setting process to ensure that we're not reneging on our targets purely because of failure to hit them, but we are setting aside capital. We're setting aside capital, not just financial capital, but also our human capital and all our resources towards achieving the targets that we set rather. An interesting dimension around targets would be our climate-related targets, and this sit in what is called a transition plan. Most organizations will have a climate policy in place, and this is where your climate ambitions would ideally live. And the questions then are, what actions are you taking to achieve those targets? And investors will be looking at this particularly because this is what would essentially track your progress. Now, what reliefs do we have within the standards? The first year of reporting, which is 1st January 2027, you are not required to have such comparative data in the first year of reporting. So if 1st January 2027 to 31st December 2027 is your first year of reporting, it is not a requirement that you show us historical data from 2026 and backward. 2027 can be your base year. The other thing that you had given a relief on is scope 3 emissions. So these emissions are not required in the first year. And in the year, you'll be required to just put in place the structures needed to report, because scope 3 can indeed be complex because of the stakeholders and where information will ideally sit. In the first year, if climate is a sustainability risk for your entity, you're allowed to only report on climate in the first year. Also in the first year, you are allowed to produce your first report up to 9 months after your financial year ends. So what that means then is in the first year, 9 months. So if you have a year end, September 2028, you don't have all that time to release your first report. But subsequently from year 2, the same time you release your financial statements is the same time you'll be releasing this report. Also, estimates, of course, will be allowed, especially around scope emissions. We'll use a lot of proxy data at the beginning before you develop structures to be able to get actuals. What is required in year 1? First, you need to disclose how your governance is set up. This means, what does your board have enough competence? And this is where capacity building would ideally come in for our boards and their management teams. You'll also be required to do a materiality assessment. And I've mentioned that already ISPAC has provided a web-based tool for, let me take that again. You'll be required to do a gap assessment. A gap assessment, we've already provided a tool where you can be able to do a gap assessment for your entity. From a materiality assessment perspective, this is also a requirement before you do any form of report. You need to sit down, look at the universe of material issues that would primarily affect your enterprise value and report on this. You need to identify your risks. You need to have your strategy disclosures. And more importantly, you need to include a statement of compliance in your report that you have complied with the requirements of the standard, and where you have not fully applied, the extent to which compliance has been achieved. In terms of identifying what to report, the standards are very clear. We normally call it the water approach. And here, the first primary source of what to report on is the IFRS S1 and S2 standards. In the event that your risks are not already captured within these standards, you will defer to the SASB standard. SASB stands for Sustainability Accounting Standards Board. They have developed standards for 77 industries. So my cheat code mostly for most entities, I tell them, just go, and this is an open source kind of standard. Just go and Google SASB standards, go to your industry and check what is the requirement for my industry and report on those. Don't reinvent the wheel too much. Then in the event that there are other topics outside of S1, S2, and SASB, by the way, I also need to mention as a SASB, the standards say that entities shall means mandatory. You need to consider, you need to first go and look at SASB before you say those matters are not applicable to you. Other additional sources include CDSB for water and biodiversity framework, GRI, ESRS, and other standard setting bodies based on your materiality universe. So this is sort of the three-step process that you need to think about as you determine what are the material issues for organization and what issues do we need to report on. S2. S2 is the climate standard, the first topical standard within the suite of standards. And you cannot report on S2 without using S1. Remember, I mentioned that S1 is your backbone, it's the principles. S2 is the first topical standard and it speaks to climate related disclosures. Now, in the near future, we will have new standards and they'll be possibly called S3, S4. So we have most what is in the grapevine at the moment, what we're trying to develop is nature related disclosure standards. Maybe that will be S3. We also have human capital, which is also in consideration. And there's also one on, I already mentioned the human capital. So those are some of the pipeline that you need to look forward to in the near future. But S2 currently is the only topical standard in the IFRS suite of disclosure, sustainability disclosure standard. And when you think about S2, you need to think about it in two dimensions. One is physical risk, and two is transition risks. Physical risks can be thought again broken down into two: your acute and your chronic physical risks. So by acute risks, we mean risks that we're used to seeing, floods in Nairobi, and all these discrete events that happen around our nation today and affect our businesses. So flooding, droughts, these are some of the acute manifestations of physical risks. Chronic risks are things that take some time to materialize. Things like increase in temperatures, sea level rises, and changing rainfall patterns. These are things that take some time to evolve. And from a Kenyan perspective, we have seen that our rainfall has increasingly become not very reliable in the recent past. That's physical risks. Transition risks happen because of the shift towards a lower carbon economy. And here you need to think about what are some of the policy and legal changes. I think in the last budget, Kenya was even mulling a carbon tax. Other jurisdictions such as the EU already have something called the EU CBAM, Carbon Border Adjustment Mechanism. That means anything that's imported, some goods that are imported into that jurisdiction then are imposed an extra tax. In Kenya, we've also seen, and in other jurisdictions, you're seeing a shift towards more and more regulation. How do this affect our businesses? Technology-wise, things like electronic vehicles were not there in the past. Now they have become mainstay. How does this mean? What does this mean for organizations that deal with, combustion engines in whatever form they do? Market and reputation. Consumers now are becoming more conscious with regards to what they buy and the ethical considerations with some purchases. What do this mean for your market and for your reputation? So these are the transition risks that I'm talking about. Now, one of the major things that you will see from a climate perspective is a requirement to do a scenario analysis. A scenario analysis, simply put, is asking yourself, is my business resilient? If it's not predicting the future, it's just asking ourselves, if temperature were to increase by so many degrees, what does it mean for our business tomorrow? Is our business model resilient enough? And there's been models that have been put forth But the most common one is what you're seeing on my screen now: an orderly transition, a disorderly transition, and a hot house world scenario. Orderly is where carbon prices are rising steadily, policy is working, and there's rapid decarbonization. Disorderly, late policy action, and hothouse is no significant policy action is taken to reduce global temperatures, and this definitely will have an impact on our businesses. So what S2 requires you to think about from a climate perspective is what risks are we faced from a climate perspective, and model scenarios based on the same. So this is a requirement of IFRS S1 and S2. I could have spoken more about scenario analysis, but it probably requires a whole session on its own. But think about it as, what does this mean for my business? Will my business be resilient in the near future? You need to do that kind of modeling and disclose that in your sustainability report. Now, allow me to skip this in the interest of time, but to share the slides. Some questions you need to think about from a scenario analysis perspective. What scenarios concern you the most? What will be material for your organization? Let me talk about data and reporting challenges. Now, the biggest gap that most organizations are likely to face is to underestimate the data problem that is required to meet the requirements of the standard. The first thing you need to think about is who owns the data. Now, sustainability data, as you have realized, sits in operations, sits in HR, sits in finance, sits everywhere. Who owns which data and who is consolidating this data? It needs to be very clear at organizational level that ownership mandate. From an audit perspective, everything that you will disclose in your report will need to be supported, will need to be signed off by someone. If you cannot show this trail, then when your auditors come, they will probably flag those and give a negative opinion. From a systems perspective, most ERP systems are already not configured for sustainability reporting. What does that mean? Does it mean we need to get additional systems? Can our systems be configured to capture sustainability data? Very important. Internal controls. What are the motions that sustainability data moves before it becomes reportable? Most of us will be given manual spreadsheets, but even if we are using these spreadsheets, do we have access controls to them? Very crucial. Data quality and estimation. It's important that you disclose how you have estimated your data. You're better off having no data than having poor estimates and reporting them on your report. Auditors will definitely qualify your report. And then from a scope 3 value chain perspective, things you can do is start identifying your top clients, your top 20 clients, and start developing resources and ways of collecting data, including questionnaires, so that you can be able to start that reporting journey. We know for sure that this process is new, but you need to demonstrate that you have started somewhere. Some questions to ask yourself from a data perspective. Who currently owns your data, whether it's fuel data, whether it's headcount data? Who owns that data? If an auditor was to come and ask you to support those figures you report, would you be able to produce it? And more importantly, what is the biggest data gap you need to close before 2027? Crucial questions that you need to ask yourself as you think about your data architecture and how data will flow across the organization all the way to reporting. Now, I'll speak about finance emissions. But before that, allow me to paint a picture about the other scopes. So from a greenhouse gas emissions perspective, we have three different scopes: scope 1, scope 2, and scope 3. Scope 1 is your direct emissions from your own operations. So think about the generators in your companies. Think about company vehicles. All these are sources of scope 1 emissions that you can measure directly and report on. Scope 2 is your indirect, and this one is mainly your purchased electricity from Kenya Power. Normally, they indicate the number of units consumed or bought. And the question then becomes, how do you compute your emissions based on some of this legacy data that you already have? So scope 1 and scope 2 are relatively easy if you think about it. It's more about a reorganization of how you capture your data. Where the real work sits, particularly for financial services entities on this scope, is in your value chain, your scope 3. Now, 95% of your total emissions are likely to be your scope 3, especially if you're in the financial services sector. And so most of your efforts really need to be on your scope 3 emissions. And this is where the data becomes material for you. Now, there's a whole protocol called the GHG protocol that has been developed to help you think about how to compute your emissions. And maybe the next upcoming sessions, and I know we'll have more, that will definitely be a standalone topic that we can be able to cover. But one thing you can start thinking about, especially if in your financial services sector, is something called the Partnership for Carbon Accounting Financials, which is a methodology that has been developed to be able to compute your scope 3 emissions from what we call category 15 finance or investment emissions. Same would apply for anyone who is insurance, whether you're a bank, any emissions that you have facilitated. This pickup method would help you think through that. And the pickup method has different scores based on the quality of your information. Now, scored from 5 all the way to 1, where 1 is the best, it would be actual emissions data that you would have collected from your value chain. 5 is using averages and proxy data. So on the continuum of 1 to 5, you would rate your emissions data. And this is actually one of the things that you can actually disclose in your sustainability report. How do these standards integrate with your risk architecture as it currently is? So we already mentioned that you have an ERM system. This ERM is a reportable matter to your board currently. So what you're doing is overlaying it with climate risk and other sustainability related risks. Also, you need to think about how do these risks and the scenario analysis that you will do as well speak to how you are approaching your scenarios and your climate related risks, and how do they influence your strategy. The other thing from a risk perspective and your risk architecture is already you have an internal audit or a compliance team. What does this mean for their mandate? Definitely an expanded mandate because of this S1, S2 data. They need to ensure that they have reviewed your materiality assessment process and that your governance disclosures are also accurate. From a capital perspective, for organizations, particularly in the financial services sector, capital planning, capital adequacy requirements would be affected by some of these climate stress tests. And those scenarios that I talked about from a scenario analysis perspective, you need to show us what do they mean and how do they affect your enterprise value. So this is some form of architecture that you can think about, all the way from your ERM to how it affects strategic planning, to the new roles that your internal audit and compliance teams will need to play, and what it means from a capital allocation perspective. This is what you need to think about from a risk perspective. Let me speak about assurance. Assurance is key to how this information will be sitting in your report. Remember, as I mentioned, these disclosures are supposed to support investor decision making. So they need to be investor grade kind of disclosures. And in most organizations, we have what we call the three lines of defense. Your first line would ideally sit within your operational management. And these are the people who own the data collection process, the computations, and the initial controls. Your second line is your risk and compliance. This is where your internal audit teams and any compliance teams would ideally sit. And they basically review your policies, your controls, the methodology validation for most of these computations, and more importantly, the oversight as well. And then the third line, which you could argue is for organizations that don't have their risk and compliance sitting separately from the internal audit. Again, internal audit could be your third line of defense. And your last line would be external assurance, your auditor when they come to audit your books. So internal audit would provide some dependent assurance over your data and your disclosures and your controls. And your auditor, when they come to audit your disclosures, then they would use methodologies that have already been developed. There's a standard called ISA 5000 that already speaks to how auditors should audit sustainability related information. And here of note is that when you're choosing your auditors, please choose them from the appointed auditors list that ISPAC already publishes every year on our website, so that you ensure that you're working with professionals. Now, some assurance gaps that you need to think about, the things that will make your auditor qualify your report. The first thing is that you don't have a documented materiality process. What that means is, how are you reporting on what you're reporting in the first place without a materiality assessment? It's impossible. So even before you begin a conversation, if you don't have a documented materiality process, your auditor will not be able to proceed with an audit. So if you're a leader on this call, the first thing is to commission a formal materiality assessment. Document it and let it go all the way to board level so that it can be approved. In terms of your data, everything must be supported with data. All your computations, your sources of data, every number that appears in your report must be supported. So an action for your CFOs is to map data flows for all material topics and assign ownership. From a controls perspective, your IT teams will be very crucial in ensuring that your systems, whichever systems you use, would have maker checker controls, would have segregation of duties within those documents and version controls, so that auditors can have the assurance that they need that the information is accurate. From a board approval perspective, that's the first thing we'll check. Was your report approved by the board? Are there any board minutes supporting that? Is there a documented review process? So all these minutes need to explicitly show that the board is on board from a sustainability reporting perspective. So I was asking here, are you ready or do you just think you are? So on a scale of 1 to 5, how confident are you that you could pass a limited assurance review today? What is that one governance change you will take the next 30 days? And most importantly, the biggest resource constraints to your readiness. You need to identify it and close it as early as now before you start any assurance processes. Finally, let me speak to a possible roadmap organizations can think about. Now, what's some of the quick wins you could leverage on between now and the first 30 days? when governments come into power, there's normally that thing of the first 100 days. Similarly, yeah, we're using first 90 days between now and when you start your reporting. First, build your governance foundations. Let it be a standing board agenda. Have a cross-functional team within your organization that will be able to have some form of leadership and cross-cutting representation. If you're a public interest entity, you need to brief all your executive committee members on the obligations for this and do your readiness checklist that ISPAC has already provided. And you have 2 days for that now. Then the next 31 to 60 days, do a materiality assessment if you don't already have one. Map all your data sources to the requirements of the standard. Review your operations, identify your risk exposures, especially from a climate perspective, and assess whether your ERP is still fit for purpose to help you meet the reporting obligations, or do you possibly need another system? If not, start with Excel, as long as you know you have version controls and the information is accurate. Then 61 to 90 days, build and engage. Implement maker-taker controls, design data ownership matrices, have conversations with your regulator, and more importantly, start thinking about who can offer assurance from an audit perspective. Okay. As I move to conclude, this is possibly a bigger and more detailed implementation roadmap that walks you through all the way to 2028. I will skip this for now because you'll receive this slide, but just know that you need to work on your governance, your data controls and your baselines, your integration and pilot reporting, and your assurance. Those are the buckets you can think through and have structures for. I've also left here a possible governance checklist that your CEOs and senior leadership can think about on some of the things that would be crucial for you to have as you start this journey. And some of this, of course, this is not an exhaustive list, but this is something that can start you off on what you need to tick off. And they cut across governance, strategy, data and reporting, and assurance. So let me finish with this final slide. 10 things you really need to get out of here knowing. The first thing is this, that these standards are regulatory obligations now. And if you're a public interest entity, 1st January 2027 is your first port of entry. The next thing you need to think about is who owns the responsibility over these disclosures? The management and the board. Very important. The other thing is that these standards are financial materiality standards. Only disclose the things that affect enterprise value. And I will repeat, only disclose things that could reasonably affect enterprise value. Anything that is impact materiality based, you need to defer to other impact standards such as GRI. The other thing is the 4 pillars: governance, strategy, risk management, and metrics. These form the core pillars. So for every material topic that you will have, you will need to demonstrate how you have addressed these 4 pillars across all the material issues. As ISPAC, we've already released illustrative reports on how possibly you can think about your journey. If you're in insurance or in agricultural sector, we have already released this on our website, and you can go and check how an illustrative sustainability report based on these standards can look like. From a climate risk perspective, we said we have physical risks, your floods, your droughts, and your transition risks. as a result of policy changes, technological changes, and market shifts. Then, number 6, financed emissions, scope 3. That's where it's at, especially if you're in your financial services. Please begin early. Financed emissions are gonna be a headache for many people. So start thinking about what it would mean to set up structures for that. The 7th point is in data quality and audit trails. They are as important as the disclosures themselves. The end does not justify the means. Auditors are interested in how information is collected, consolidated, computed, and not just the end result. Assurance is coming, 2028 for public interest entities, evolving from limited to reasonable assurance. And limited assurance, maybe for those who might not be familiar, is just saying, from the word limited, the auditor just gives an opinion on a few metrics. But from 2028 for PIs, then they will give assurance on everything else. So you better watch out that your reports meet the required guidance from a reporting perspective. Then, if you have not done the readiness checklist for ISPAC, I mentioned our deadline was 30th June initially. We extended this to 31st of July. So you have already 2 days. And then finally, it's a strategic opportunity. Think about it from a transformative perspective as to how your business remains resilient into the long term and not just a compliance exercise, a tick box exercise that you need to just do for the sake. With that, your next steps: do the readiness assessment, table this as a board agenda, appoint a work group if you already have not, conduct a gap assessment within your organization again, based on what we've covered today. Engage your regulator, work closely with your regulator depending on the industry. And then in case of any technical support you may need and any training resources, please do reach out to ISPAC. We are more than happy to assist on this journey, and we work closely with Global Compact to ensure that these standards are embedded in everything that organizations do in the long term. Thank you. That was it from me. I'll now hand over back to Steve before we take a Q&A. Steve?
Yes, thank you very much, CPA Elvis. That was a fantastic presentation, and thank you for also keeping time. I think we first have a couple of questions that are on the checklist. Maybe we could go through those quickly, and then we could come into the closing remarks very shortly. So maybe we can just go through a few of the questions on the chat box. And then we can respond to them. So anyone else who has questions there, please post them there, and we can respond to them. So we have a question here from Haneda Anita. I'm an ESG consultant that provides an ESG AI system that helps companies with data collection, management, and reporting. Our system is highly customizable to organizations' need. Would love to understand a bit more on what these data challenges are. Did you get that question, Elvis?
If I got you right, Steve, was it data challenges?
There was a question around
question. They'd love to understand more about the data challenges.
Yeah.
Yeah, I think from a data challenges perspective, the biggest challenge I foresee for most organizations is around what I mentioned around scope 3 emissions. Let me give you a quick example. If you are a bank and you have a core banking system that has some customer data when you open accounts and whatnot, So if you give me a loan and I am doing farming in Uasin Gishu, and climate risk, as we've already established, is one of the material risks for many organizations. The question then becomes, how do I reorganize my core banking system to collect climate data, which is a reportable item for me, especially from a scope 3 perspective? How do I collect scope 3 emissions data from my value chain? That is the biggest data challenge. The other challenge is that most entities will begin with legacy systems, Microsoft Excel. There's nothing wrong with that. But what we're saying is, do they have version controls? Do they have internal controls? Do they have make a checker reviews so that someone can, when someone comes to audit that workflow, they can see that it went through some processes before it is reported on. So scope 3 legacy systems, some of the biggest data gaps we see, and also the fact that this data sits across multiple departments within an organization means that there needs to be a system that can help everyone to put their data into one system before the sustainability team can now use this data to report. So I would highlight those three, Steve, at the top of my head on the data gaps.
Yeah, thank you for that. We also had a secondary question here from Trevor Combo, who's a nature and climate and communications consultant. And his question relates to where the communications and narrative discipline enter the readiness process. So he mentions that alongside the data architecture, or after the, is it alongside the data architecture or after the technical content is finalized? His concern is that the standard practice is that communication enters last when disclosure. Did you get the question? Elvis? Coming again with the question. The question is, standard practice is that communications enters last when the disclosure is already done and the writing gets treated almost like cosmetic surgery. What's your view on when to bring in the communications team into the room? Elvis?
Could
Or yeah, you could respond to that and so on. Yeah.
Yes. So for me, I think our view is that communication shouldn't be involved. At the end, it should be involved at the beginning of the readiness process, because oftenly sustainability, it follows this process where you're looking at finance and sustainability risks, technical experts, they draft the disclosures and all that. And then our communications are only brought in to make it sound better. But the challenge with that is that by the time communication joins in, the data is already written. And if there are any gaps or inconsistencies or unclear messages, then they are much harder to address. So I believe that communication should be brought at the beginning of the development of the data. Elvis, I think, is back. He can take in the next part.
Yeah. Thank you, Ivonia. Elvis, we were just responding to a question on when to bring in the communications team, but Ivonia has already addressed that one. Maybe a question here that you can respond to is around holding companies.
You're on mute. We can't hear you.
Oh, Steve is not.
Am I audible?
Yes, you can hear you, Steve.
Great. So the question here is around subsidiaries. So for the impact assessment, if you have submitted as a holding company, do your subsidiaries need to submit as well? This is the IFRS mandatory readiness assessment.
Yeah, so the requirements of the standard is, if you're as a 10-year, you produce a consolidated integrated report of your financial statements for that matter, which would ideally include your subsidiaries, then the sustainability report will be required to include your subsidiaries as well. Same kind of dispensation. So if you consolidate your subsidiary, you need to, of course,
we're losing you, Elvis.
the first thing. Okay, there are gaps that would necessary. Yeah.
Elvis, we're losing
Sorry,
you.
my
Just,
internet keeps on. Yeah, let me say that again. If your subsidiary is in an industry where the sustainability related risks and opportunities are unique to that industry, it might be prudent to do a separate readiness assessment if you assess that the risks and opportunities are very unique to that industry. But the rule of thumb is if you consolidate them in your integrated report, then that one assessment at group level should cover it. I hope that was clear, Steve.
Yeah, I think that was quite clear. So it's not mandatory, but it's advisable if there are significantly different risks that apply there. Just confirming that there is no other question that has been mentioned. Some of the questions that we are seeing here have already been mentioned or been spoken to in reference to the materiality requirements. Is there any other question that may have not been addressed to?
Can I speak to the comms? I think I found Ivonia running with the comms question. And Trevor has added wood to the fire and has said most disclosures will be written in language investors, both journalists can't actually use. Compliant, assured, and communicatively dead. I agree to that extent that for sure, even if you read financial statements, they can tend to be quite boring if you're not used to that kind of language. But what you're saying is that comms people are not entirely removed from this process. In fact, comms people play a very important role in ensuring that entities are communicating accurate information. But what you're saying is that the comms need to avoid boilerplate language as far as the SWOT and is concerned, and speak to the realities of what the numbers and the disclosures are saying. So maybe I just wanted to add that aspect. I see there was a hand from MGI, Aleki.
Yes, hello. Can you be able to hear me?
Audio is good.
Yes,
Okay. Now, I had asked a question in the Q&A, the Q&A dashboard. Will SMEs gain any advantage if they adopt sustainability reporting, given that it's not mandatory for them, yeah? And also, how will they stand to gain if they choose to adopt the same?
Yeah. What's happening is for SMEs, you want to agree that the journey will be a long one. A lot of sensitization we need to go into this kind of reporting. But one of the things you need to realize is if you're an SME and for instance you're taking a financial a financing facility from, let's say, a bank, this is information that banks will now this is information that banks will now start asking. So what does this mean for an SME? As ISPAC, of course, this is our challenge, and that is how do we unpack these standards in a way that SMEs can be able to report? So part of the illustratives I mentioned that you have listed plans and agri for now. But subsequently, one of the areas that we are very keen on is on SME reporting, given that SMEs are perhaps the bulk of most companies in this country. So, and this would involve building systems, more intuitive systems for SMEs to comply, and asking them to and possibly thinking about doubling down on some of the requirements of the standard to make them more palatable. For instance, on the accounting side, we have the IFRS accounting standards, but we have developed a lighter version of this, and we call them IFRS for SMEs. So hopefully in the near future, we can develop a standard that now speaks to the less complex nature of SMEs and make it easier for them to be able to comply from 2029 onwards.
Thank you for that.
Kabale's hand was up at some point. Kabale, are you still with us?
Yes, yes. Hi, Vanya.
Hi.
Yes, it was answered. Thank you.
Okay, Kadu,
All right.
your hand is up.
Yeah, thank you, Ivonia. My question is around on risks around assurance. What happens if, for example, you have you've already picked an assurance agent to be able to run through the assurance process, and then maybe that assurer you're in the middle of it, and then or you have already concluded the assurance process, and then the agent is blacklisted for malpractice by an authority or a stakeholder. How do you handle that? Will that then impact the entire process?
Someone just get your question correctly. Is this from a sustainability reporting perspective?
Yes, from a
kind of
sustainability
Okay,
aspect reporting.
Assurance, yeah.
Correct.
Yeah, I think as a regulator for assurance providers, I mentioned that we publish a list every year on our website of assurance providers that have met the requisite requirements to be able to offer such assurance on this data. So once we publish that list, it means that that person is ideally cleared to offer such services. Should it happen that midstream something happens, I think it'd be important to get back to us as the regulator and report any form of malpractice or anything that could lead to termination of such a contract. But there's ways that you can hire and fire an auditor that follows due process, and that's where you involve us as the regulator to be able to midwife that process, especially if there's malpractice involved in the nature of the work that this practitioner is offering to the market, or if the work is substandard for that matter. So we do have due process, and if you were to reach out to us, we'll be able to deal with such a matter.
Thank you so much. Mm-hmm.
Maybe a follow-up question is on the aspect that you are working with the agent, and then maybe somebody like a World Bank come and say they've realized within they are working with the same agent, they had malpractice or they had misreported, and you're already in the middle of reporting with this agent. What happens? Do you stop and hire another one, which will bring in the cost aspect, or do you proceed and conclude the process with them?
That I think now I know who you are referring to without naming names. But I guess that's a tricky one, because now it has to be a leadership, senior management kind and board level kind of decision on whether to stop engaging this practitioner purely based on the reputation that your report might have. So I want to say it's a judgmental issue, but the substance of the malpractice needs to be very clear, so that you do not just discard a practitioner for the sake, just because a World Bank has said there was something that happened. And also, when World Bank actually brings those things to light, they give them remediation steps, and then later they reinstate them back. to do work for them. So it doesn't mean that one instance of malpractice is enough to just discard an auditor. But again, judgmental.
Okay, great. Thank you.
Thank you. We have another question, which is Global Compact. Doris, you're asking whether when you submit the COP, you will not be required to submit the IFRS report. Being an SME first and a business participant, for the COP, that's a mandatory reporting requirement, that is the communication on progress. However, IFRS sustainability disclosures are, being adopted by regulators, and for SME, I believe it's mandatory beginning 2028. So that will be more or less an additional report on top of your COP. I'll read other questions. I think they are missed on the Q&A. If they've been answered, you can let us know. There's a question where Grace is asking, would you please speak on double materiality? I don't know whether that was sorted.
No. Did I speak to? I mentioned it in my presentation. Double materiality is essentially financial materiality plus impact materiality. Financial materiality is what S1 is to fronting. They're saying only report sustainability related risks and opportunities that affect my business. And by my business, I mean my enterprise value. And by my enterprise value, I mean my profit and loss statement, my cash flows, and my balance sheet. That's financial materiality. The other side of the coin is impact materiality. It's asking the question, how does my business impact the world around me, the people, the environment around me? That is impact materiality. When you match these two schools of thought, you get double materiality. Double materiality is what the EU has adopted. If you read the EU regulations, they're called IFRS. They are double materiality regulations. What we are saying is most organizations, it makes sense for most organizations to do a double materiality, to approach their materiality from a double materiality lens, because they also want to demonstrate impact to the world. So the standards do not say that you should not. The only caveat I mentioned is that do not obscure information relating to the financial materiality needs in your report.
Thank you so much. Well put. There is another question from Meras. Let me know if it was answered. Does the two central banks and security exchange commissions of Kenya fully adopted IFRS? What standards, that is GRI or IFRS, and which timelines for reporting have been mandated so far for listed company or financial institute? And then a follow-up question, does IFRS require formal materiality assessment as like GRI with engaging so many stakeholders?
Yeah, so I'll start with the one for listed entities, regulators. I mentioned we have a national multi-stakeholder committee on sustainability and climate change, where all regulators sit. CBK for banks, RBA for pensions, IRA for insurance. Listed entities are represented by CMA. The National Treasury sits there representing the government and many other stakeholders, including public sector and private sector players. They developed the national roadmap. And so the standards that have been adopted in Kenya are IFRS S1, S2 as the baseline standards going forward. And this is what will be subject to compliance reporting at regulator level. So yes, the short answer is all regulators are on board with S1 and S2 in Kenya. The second question around, what was the second question, Ivonia?
The second question is, does IFRS require formal materiality assessment as like GRI requires with engaging so many stakeholders?
For sure, materiality assessment is a process that has to be done and documented. It will be an auditable issue when your auditor comes. And so you need to do a formal materiality assessment. However, the scale of engagement of your stakeholders will differ, because remember, S1 and S2 are investor-focused standards. So who you engage is important. However, if you've not done a materiality assessment and you're considering doing a double materiality kind of reporting, it makes sense to just engage everyone at once and do a materiality that captures both your impact and your financial materiality. But in case you have not done one for S1 and S2, then the short answer is that you need to do one.
Thank you so much. There's a question from Rosalind who asks, how can organization integrate the main sustainability reporting frameworks, that is GRI and IFRS, into one report, I believe?
The best way to integrate them is through an integrated report. We have the IR framework that shows you how to report on your capitals across the different capitals that you would have. And also GRI and ISSB are working on something called interoperability, so that these two standards can speak to each other and the entities don't need to duplicate information. So perhaps in a few moons coming, we'll do a matrix that just shows you areas where GRI and S1, S2 intersect, so that you don't have instances where entities are over-reporting. So interoperability is something that we're all keen on, and it is possible to integrate both frameworks into one report.
Thank you so much. Maybe I can also answer to that in regards to the communication and progress report, that is the UNGC's reporting mechanism. We actually have taken into account the interoperability on sustainability frameworks, and within the guidebook, we actually link any particular question to a particular sustainability framework, so that then it's easy for data reference. There is another question. Can you share a few examples of financial materiality in the media industry?
What would be considered financially material in the media industry?
Yes.
So I might not give you, okay, I'll try to give you one from the top of my head, but I wanted to point that person to the SASB standards. If you go to SASB, I mentioned they have 77 industries, and media is one of the industries there. But top of my head, one of the things that could be financially material for the media industry is aspects relating to data security and misreporting. Those are things that could easily get you sued as a media house, and of course have an impact on your profit and loss statement.
Yeah, and just to chime in on that is that for any of your issue areas in sustainability, when you're looking at financial materiality, you're looking at, does it affect our company's cash flows? Does it affect our access to finance, or the value of the organization? So data privacy, as Mwenga has said, is that, of course, it would lead, what would be the impact on that? It would lead to regulatory penalties, for example. It would lead to loss of subscribers. That affects the money aspect within your organization. When it comes to, for example, content misinformation, it would lead to advertisers pulling out on their spending. So that affects you financially. So within your industry, look at what are the issue areas that affect our company's cash flows, access to capital, and all that. I think that can answer, it can give you more insight into what is material or financially material within the sector. Before I can read the question, maybe I can take the hands that are up. J.O., I believe, don't have the full name.
Hello, good morning.
Good morning.
I'm Jeffa. I had a question in regards to greenwashing. Okay. How do you deal with a situation whereby there has been a consistency in regards to data collection, analysis in regards to scope 1, scope 2, scope 3, everything is consistent. However, while you're doing a site visit or site walks, you'll find that there is no compliance. So that means either they are cooking the data or something is off. However, their performance is up the par. So how do you deal with that situation of a greenwashing design? Thank you.
Yeah, Ivania, should I take that?
Yes,
Yeah, go ahead.
yes, please.
Now, greenwashing,
Yes, good
of
morning.
course,
Thank you.
greenwashing is of course misrepresenting sustainability information in your reports that do not tie back to your reality as an organization. Um, Greenwashing is some of the things that assurance will come to remove, because remember, an auditor, when they come, they will want to see, including those site visits, some of the things that you will have declared in your report. So assurance is one of the things that will happen to cure that greenwashing aspect. In Kenya, currently, there's a lot of greenwashing. You don't need to go far. If you go to your supermarket, everyone is now doing packaging that says, that is, either misrepresenting or what's the word, giving a consumer the a wrong impression about how the company is considered to be sustainable. So things like green packaging, we've seen all those things, um, things that would insinuate that a company is sustainable, but their practices are not. So those people, their days are almost coming up, and these reports will expose. In fact, in more developed countries, there's, for instance, the latest greenwashing case I saw was, if you Google a company called Shein, Shein, it's a fashion company, I think based out of is it Singapore or China. They have been fined in multiple jurisdictions a lot of money just because they have made claims on their website, on their socials, that their fashion clothes and whatnot are biodegradable when they are not. Small things that seem like an advantage, but they are borderline greenwashing. And in jurisdictions like that, people have been fined hefty fines for just making such claims. A day is coming when that will be the case here in Kenya, and many entities will be caught if they do not change their ways.
Thank you, CPA Elvis, and I know you have to leave, so we only have time for one question. Vivian, if you could please give us your question quickly so that Elvis can respond and we can release him.
Okay, thank you. My question is around the financial materiality assessment process. Is there a recommended way or a good practice on assigning weights when it comes to analyzing the stakeholder responses and the management responses? So should we give more weight to the management responses or the stakeholders, or should they be equal, given that the understanding of the material aspects that can actually affect our financials may differ from the all other stakeholders and the internal, specifically management or people in finance? Is there any good practice or recommended way to assign those weights?
Yeah, so the instances where industries where stakeholders are very strong, and but what I want to say is, just because stakeholders have said something is material, it doesn't mean that they pass the financial materiality test. Management would need to really sieve through stakeholder responses through those surveys that you do, and narrow down to what will have impact on enterprise value as far as S1 and S2 is concerned. So don't be bullied by your stakeholders to think some things are material, but on the ground, when you look at the business and when you look at the connectivity, the financial statements, they do not meet the financial materiality threshold. Engage them, let them give you the universe of sustainability issues, but at management and in-house level, then you need to sift through that financial materiality lens to get what is ideally material for you.
Okay, thank you very much. We've come to the end of today's webinar. Thank you so much, CPA Elvis, for taking us through that very detailed overview of S1 and S2. He has given us quite some very practical next steps that we can all take, which were in, I think, the slide on there. Yeah, so it's to complete your readiness assessment by 30. So by 31st July, which is, as I mentioned, is just a day or two away. So if there's an action item, please prioritize that as the first. We recognize at the time and the structure of this webinar was also introductory to give you a high level of what you need to know going into the regulations period. But we are also pleased to share that we are also organizing an in-person workshop. This will be a paid session. It's about 2-day session. We will have CPF is there in person and also other experts around IFRS 1 and S2. And it'll be a deep dive for those who are engaged in the reporting within their organizations. We will share more information around that as we share back the slide decks to you and the recording of this session. So please feel free to register your interest there so we can pick up our conversations at an individual level. Beyond that, we also encourage you to join the Global Compact. A lot of the questions that have been raised and that haven't yet been raised are supported through our offerings, through our academy, our accelerators, our COP framework. We have a support system that's there for you if you are not already a Global Compact participant. So just wanted to put that out there that we will have an in-person deep dive workshop 1 or 2 days. We're still in the planning stages of it, and we will share more information on that as we share back to you the slides. Beyond that, all I just want to say is thank you very much for joining the call. It was a very engaging session, especially towards the end. Thank you for your questions. Thank you for your insights. We have taken all of them in, and we look forward to further engagement. So look out for the email, which will have this deck and also avenues for deeper engagement. Beyond that, thank you very much for making time. It's 11:57. We've stolen quite a bit of your time. I'd like to end the webinar there. Thank you very much for your participation. Until the next one.
Bye.